I'm definitely excited for a much less narrow market. 2023 was one of the most narrow markets we've had on record, which is incredibly strange if you think about the wide range of outcomes, not only in the economy, in the geopolitical landscape, interest rates, et cetera. So having a really narrow market with a wide range of outcomes leads one to believe that there are just a phenomenal amount of opportunities coming our way in 2024. If you look historically, I think it's over the last 90 years or so, the dividend has been about 50% of the total market return. What's even more interesting is in times of stress, whether it's inflationary, stagflation, economic recessions, that number typically goes up to 75–80% of the total market return. So obviously a huge part of the wealth you're trying to create. Additionally, for us, dividends serve as a mechanism to signal future value creation. We spend a lot of time looking at the free cash flow generation of companies and what companies do with that free cash flow. Really high quality management teams tend to pay and grow dividends over time. That's not to say that we're looking for the highest yielding companies. Typically those can be some of the most risky companies in the market. What we really key on is those companies with a payout ratio of say between 20 and 40% depending on the industry. Those are the companies that will be able to continue to raise and pay dividends over time. I think it comes down to a few things. One, it would come down to brands, innovation, the management team, and probably most importantly, especially over the past couple of years, is the notion of pricing power. Companies that have sustainable, long-term value-creating businesses have pricing power. Companies that don't have pricing power, maybe they're cyclical, maybe they're structurally flawed, those companies tend not to do well over time.